Hey, I'm here with Doug Greenberg. He is a tax attorney located in San Francisco and specializes in international tax. And I've got him here today to talk a little bit about common tax considerations for people who have international assets or maybe moving internationally. And we're lucky to have Doug here. Doug, thank you so much for being with us.
Thank you. I love to be here.
Yeah. Well, let's dive right in, Doug. We'd like to deliver as much value on these webinars as possible. So, if I'm someone who has international assets, what's some of the low-hanging fruit tax-wise that I need to be aware of in the US?
Yeah. Well, so first off, forms. There's lots of additional forms that need to be filed, and there's lots of confusion about these forms, and rightly so. They're complicated, they're often redundant, and they don't actually affect your tax return. What is happening is the federal government, for reasons that go back decades, are suspicious of people that have foreign assets. And these rules were created around tax evaders, money launderers, and they're created back in the 70s, sometimes earlier, depending on the rules we're talking about. And the amounts haven't really been updated. What was a lot of money in the 60s and 70s is no longer a lot of money today, 50 years later. And so a lot of people who are just middle class, ordinary rank and file people are being swept up by these requirements and subject potentially is really heavy penalties, even though they're far from, they're not international criminals. They're just people who are going back and forth between different countries, maybe traveling for work, maybe they immigrated here, whatever. And so, there are big penalties associated with failure to file these forms because of the historical context these rules were created in. And the forms are very complicated and they're very numerous. And so the best low hanging fruit the most low hanging fruit you have here is just to be aware that these forms exist and to file all of them timely so that you're not having problems there.
Okay, understood. What is a typical penalty like on failing to file?
Well, it's hard to even say because the penalties range from like $10,000. They can be a percentage of the account. They can be a percentage of a gift. And so, in the tens of thousands of dollars is like the floor. It's not the ceiling.
Okay.
You can quickly get into the 6, 7 plus figures with these types of penalties.
Got it. Okay. So proper disclosure definitely required in these situations. Now, if someone is moving from the US to another country, are there any steps that they can take prior to leaving that might make their tax life easier in the future?
Yeah, that's a great question. So, I mean, every country is different and has its own tax system, which is obviously complicated. Um, and once you become a resident of that country, you want to probably find a professional in that country, if assuming your employer is not providing one or providing a service that can help you to navigate that, because that's a whole ball of wax in and of itself. Back here at home, your tax reporting obligations don't stop or take a vacation. In fact, often they get worse and your taxes get more complicated because you may have a foreign earned income exclusion. You may now have to do these annoying foreign asset reports because now that you're living overseas, you're going to be using foreign bank accounts. You might set up foreign retirement accounts,
Right.
things like that. So basically, like a more annoying, complicated tax return is just part of the bargain if you move overseas.
Yeah, and I've noticed that when my clients move, from one country to another, they always, the tax year in which they move tends to be more complex because they have income in two countries. How do you typically deal with that?
Well, yeah, that's a whole ball of wax in and of itself. There's foreign tax credits, there's treaties, there's other things that hopefully prevent the person from paying tax twice on the same income, being
Right.
double taxed. And it's just there's so many ins and outs to that there are whole departments at large accounting firms dedicated to this exact issue. Um, Besides the basic stuff, I mean, there's just additional complexities you wouldn't even think of. For instance, if you move to Australia, their tax year ends in June, so it's a
Right.
July is basically our January 1st over there.
Mm.
Um, and so how do you figure that one out? What's your tax for the year when your Australian taxes are bifurcated between two of our years? Tons of issues like that. And you just need somebody who specializes in this stuff to get it right.
Right. Makes sense. Okay. And so, obviously, avoiding double taxation is huge, and you've got a process for that, which is great. The other thing that I often run into is that I've got a number of clients who are moving sums of money from the UK or India to the US. What do they need to be aware of tax-wise when processing these transactions?
It's ironic is that I get the most calls, or at least a lot of calls, about exactly what you're saying, people wondering how to move money into the United States. That's actually the least problem causing, or typically the least problem causing thing to do, because it alleviates, at least in the future, all of these annoying reporting requirements. And people have this assumption that if they move money from one bank in a foreign country to a bank in the US, that's going to create a whole lot of taxes. But it's no different than you transferring money from banks here. The only real issue that can happen there is if you're liquidating things. So if you're selling securities in order to free up money to move, well, just like it would be here, those liquidations may trigger capital gain or loss depending on your situation.
Understood. Okay. That makes sense. Let's take a look at a more specific situation and see kind of like how someone would go about dealing with this. So, let's say I've got a client here who has received a large RSU grant. They work for one of these, Magnificent Seven companies here in the Bay, and they received that grant while they're here in the US, and they were then relocated to another country, let's say the UK. How is this person's income taxes going to work on the RSUs? And let's assume it's a 2-year gig in the UK and then that he's on a 4-year vest.
Right. Yeah, and that's a great question. Generally, the starting point for this would be to look at the UK tax treaty.
Okay,
And oftentimes in these types of situations, I'm not saying that this would be the case here, but in a situation like what you're describing, oftentimes what happens is some kind of a time allocation is required, usually between the time of grant and vesting. So if 50% of that time was in one place and 50% of that time was in another place, when the shares vest, it may be 50-50 income. Or there may be a treaty exception to that. So you kind of have to dig into both the rules, both the regular tax rules and the treaty. You also have to dig into often the person's equity plan and documents to see what's going on. So yeah, a lot going on in those situations.
and in those scenarios, is the individual is filing a tax return both in the US and the UK? Is that right?
Typically, yes. I'm not a specialist by any sort in anything but U.S. tax law,
Sure.
but often they will be required to file a return in both places. And sometimes, depending on the employer, sometimes employers offer what are called totalization agreements, I believe, which basically is shorthand for we're going to make you whole if you end up paying more tax than you normally would had you just stayed here in the United States. And there's advisors that do all sorts of complex calculations to figure that out. Yeah.
Understood. Okay. And then how does taxation typically work in the case of stock options, right? So let's say someone has exercised incentive stock options here a couple of years ago, and perhaps that stock is still illiquid. They then later move out of the US and sell those shares subsequently while they're living abroad.
Right. Yeah, great question. So if they're a citizen or a green card holder, you're taxed anywhere on any income that you earn all over the world, right here in the US, whether or not you're living there. Unlike the scenario we were addressing before, there's no need to do a time allocation here. So no allocation would be required. Usually these types of issues, if you're a non-resident alien, I believe there would be you would just look to the sourcing rules, and I believe the sourcing rules here are based on residency. I'm not confirming that 100%, but usually that's the case. So you'd have to look to, number one, the person's immigration status. Are they a citizen, green card holder, non-resident alien? And um, yeah, is there some sort of treaty provision that applies?
Cool. And I'm not holding a gun to your head on any of these on any of these
Yeah,
answers.
please
I know
don't, because I don't have these treaties memorized.
that.
Yeah.
Yeah. Cool. And then what are some common disputes that you help your clients resolve? Like what are some typical use cases that people are coming to you for?
Yeah, so great question. There haven't been quite as many disputes as there were historically with the IRS, and the reason is because of just budgets.
Yeah.
So we're kind of leaving a world where, for certainly people that were certainly born in the 1990s, even late 1980s, they've never really known an IRS that is fully funded and audits people to a normal degree. We're kind of lived in a world of a sleepy IRS that doesn't really audit much of anyone.
Okay.
Because they didn't have any money, audits went way down, particularly in the pandemic. There were virtually zero audits during the pandemic. And they kind of went to lazy methods, which they still employ today, to catch people who are making mistakes. Probably the most common thing that people can do to help themselves is to avoid the dreaded CP 2000 notice.
Okay.
That's the notice you get when you just don't include a tax form on your return. Very easy to do, right? It gets lost in the mail. Tax guy drops the ball. Something gets lost in the shuffle, whatever. Unfortunately, you don't get that notice until about a year and a half after that tax return has been filed, when you've totally forgotten about all of this and moved on with your life. Then you have
Yeah.
to go and start backtracking, finding the thing. You have to hire somebody, they have to file responses, you have to wait a long time. That's an old school process with fax machines. So just one, if you're filing an extension, you can actually get a transcript from the IRS, which you can do yourself with an IRS account, of all of the tax documents they have on you. Make sure that you have all of your stuff to avoid that notice. And two, just double check your return that they're all of those things are included. I think if you're doing that, that's going to avoid problems for like 80-90% of people.
Okay. Will the CP 2000 also be sent if someone fails to report a 1099, or is it just W-2s?
It's everything. So
Okay.
that's a great question. It's everything. So if you miss a W-2, if you miss, one of your brokerage accounts, they issued a composite 1099 with all of your different investment earnings. Any of those things will trigger a CP 2000 notice, and often these notices can be wildly inaccurate. You may have sold lots of shares, right? You may have traded a lot, generating no gain, but the
Yep.
IRS may not have any of that cost basis information. And
Right.
so in their mind, or at least the mind of their computers, you've just generated, five, 600,000, $1 million worth of additional income. You have to go back in the terrible position of having to explain, no, this wasn't actually income. I didn't actually make anything at all here.
Understood. Okay. Yeah, I've been in that situation before where, I get a 1099 that kind of late, or I misplace one, and it's, maybe it's a few $100s, and then I have to go back and amend my already filed return, and unfortunately pay the amendment fees and stuff that comes along with that. So,
Do you remember? Do you remember about how long it took you to deal with that issue?
the amendment was fairly quick because my accountant could do it, but I probably filed the amendment, a month after I had already filed my taxes. Uh,
Right.
so I guess it's probably still the right way to go about it versus waiting a year and a half and getting that CP 2000, but it was annoying nonetheless.
Oh yeah, you did absolutely the right thing. If the CP 2000 notice come, it's easily a 4 to 6 month process, if not longer.
Okay. Okay, got it.
Yeah. Other reasons people get audited and have disputes. Certainly, if you're self-employed and you're taking lots and lots of losses, like the expenses, particularly expenses to the point where you're claiming losses,
Yeah.
That's always a red flag that goes up. Rental losses when you're not a real estate professional. Also, anytime you're filing an amended return, which significantly lowers your liabilities, those get audited very frequently. And it's not that it's your fault, it's just the IRS is set up to do that.
Right. Okay. Makes sense. Well, Doug, thank you so much for joining me today on this. And for our listeners here, if you've got an international tax issue or you just want a second opinion on something international tax related, Doug is a great resource that's available to you. It's located in San Francisco, but can help clients all over. And Doug, if anyone wants to get in touch with you, what's the best way to reach out?
Just call me. It's 415-287-9990. Again, 415-287-9990. You can also Google me, douglasgreenberg.com. I tax attorney, San Francisco. And thank you so much for having me. This was great.
Yeah, of course. I'll include your email address as well when we send this out and appreciate you doing this.
Awesome. Thank you.
All right.